Hi, my name is Chris Laurie and I'm the Senior Portfolio Manager here at Fiera Capital for the Tactical Bond product. I'd like to now turn it over to Derek Brown, who's going to talk about some of our other alternative strategies. The idea with these other alternative strategies is we wanted to have a benchmark that has 0 years duration, so we can actually have negative duration or positive duration depending if we think interest rates are going up.
Hi, I'm Derek Brown, Associate Portfolio Manager here at Fiera Capital Corporation. As Chris mentioned before, I'll be talking today about some of the alternative strategies we have just launched here at Fiera Capital. Over the past 30 years, the bond market has been in a bull market. Rates have fallen from about 16% in the US 10-year down to 2% currently today. However, if you look back further in history, from 1950 to 1981, interest rates were only rising. From 1981, however, all the way till today, they have been declining, which leaves us with the question, what will happen next? We do think going forward that interest rates will increase over the upcoming years. However, we don't think we'll get back to those 16% levels for quite a while or even maybe ever. But we do think there is definitely inherent risk in owning a fixed income portfolio going forward. A brief example of this is that we believe that coupons no longer pay investors for owning the risk in a bond portfolio. A quick example again would be back in 1990, the Canadian 10-year bond had a coupon of about 10.5%. Therefore, on a 100 basis point increase in interest rates, you would still make a positive return of about 4.5%. If the same scenario were to unfold in 2012, the coupon is only 2.25% on the current 10-year in Canada. Therefore, 100 basis point increase in yields would see investors lose about 6.5% on their bond portfolio. That is why here at Fiera we decided to design an absolute return fixed income portfolio. We can take duration positive, down to neutral or zero duration, effectively eliminating all interest rate risk from the portfolio, or even take it to negative and therefore profit from rising yields or falling bond prices. So what does this portfolio look like that's able to have a positive return in all interest rate cycles? Well, essentially 90% of the money is in a traditional fixed income portfolio, and we carve out a 10% remainder to use as a duration overlay for the entire portfolio. So essentially what we're doing is turning duration on and off, or interest rate risk on and off, depending on how we see the market unfolding. Now all decisions made in this portfolio are based off the same investment process that Chris explained to you before. This portfolio itself is investment grade only, and therefore no high yield bonds into it. The conservative credit allocation is again the exact same as Chris mentioned before, the one that's had no bankruptcies or severe credit deteriorations in over 25 years. The vast bulk of the portfolio would be A-rated or above. We have an allocation of about 50% in corporate bonds, 30% in provincial bonds, and the remaining in federal agency bonds. The duration, again, benchmark duration of this is a zero duration. Therefore, the neutral home base of this portfolio has no interest rate risk in the portfolio. Well, what is this 10% that's able to manage duration for the entire portfolio? Well, the simple answer is essentially exchange-traded futures contracts. We use Canadian and US bond futures contracts to hedge out the interest rate risk and to take active positions in the portfolio. We take our Canadian 90% portfolio, or the core portfolio, and we hedge that out using Canadian futures contracts. Now, if we were to take a negative duration position, therefore to profit from falling bond prices, we would go to the United States and use their futures contracts. The reason behind that is essentially the volume and the depth of the market in the United States. Whereas the Canadian bond futures market trades about $60 billion per month, the US trades about $2.5 trillion per month. And therefore it's quite significant when we need to trade on a relatively active or quick basis. So we use Canadian and US bond futures contracts to take active and hedge positions. So what we would do is we would take our 90% core portfolio and hedge that out with Canadian bond futures contracts. Now a quick example would be if we had about $1 million in the core portfolio, it would take approximately about 7 contracts in Canada to hedge out that portfolio. And what that would do is that take our core portfolio duration of roughly about 7 years, and that would move us down to 0. So at any point in time, if we wanted to get long duration, we would simply unwind our hedge. Now once we're at 0, if we decide we actually want to profit from falling bond prices or rising yields, we would then take a negative duration position, generally by going to the United States. Over the long term, the goal for this portfolio is an absolute return, net return to the client of around 6 to 7% per annum. This includes a 5% distribution paid out quarterly as well. Over the long term, we expect the returns to come from roughly about 45% from interest rate anticipation, 30% from short-term trading, about 5% from yield curve, 0 to 5% from yield curve, and roughly about 15 to 20% from corporate bond returns. As Chris mentioned before, what's extremely important in any type of active strategy is a very strong and systematic risk management system. In this fund, we have two different levels of stop losses. One on an individual position basis, so each stop loss is predetermined before we enter the position. And we also have a total fund stop loss, which at any point in time of the month, whether it be the 1st, 2nd, or 31st of the month, if that stop loss is hit, the fund is completely hedged out and we wait till the following month before trading again. So in summary, just to go over the key points of the fund, this fund really is a duration management tool to help diversify the risks in a fixed income portfolio going forward. The duration bands can go either positive, neutral, meaning 0 duration, or to negative to profit from rising yields. In addition, this is an absolute return strategy. Therefore, regardless of falling, rising, or flat yield markets, we hope to achieve roughly a net return to the client of about 6 to 7%. In addition to that, our correlations, which we've achieved since inception, are very close to 0. That includes all bond markets, all equity markets, and even treasury bills. And this is the goal going forward, and it's extremely important for us that we really present this as a diversification tool for clients and their fixed income portfolios. I'd like to thank you for taking the time to listen to the Tactical Bond Yield Fund presentation, and I'd like to pass it back to Chris now for some closing remarks.
On behalf of the Tactical Fixed Income team and Fiera Capital, thank you very much for watching.